Hey guys, continuing this series on tax planning. As always, this is not personal, financial, tax, or investment advice. It's just for education. So continuing the what, we're going to move on to the grow. So when your money grows, it's going to grow in different vehicles with different time horizons, with different assets. So really, this is a concept that I want to breach now called asset location. So you probably heard of asset allocation, which basically means what is the mixture of equities or fixed income or cash that you have in a certain investment. But asset location means according to their growth potential and according to your time horizon and your goals, where are you putting certain investments and why? So this is where tax planning really makes a lot of sense. So for example, in a Roth account, if you know you're not going to distribute your funds until much, much later in life, maybe even last, you want your highest growth assets to be in Roth. Now, from a tax perspective, in your tax deferred accounts, and that could be a traditional IRA or a 401k, you'd want to put assets that would be tax inefficient. So for example, every year they may distribute ordinary income to you. Well, guess what? In a tax deferred account, any distribution you make is going to be taxed at ordinary income rates. So that's a great place to put those types of assets. And you want to be a lot more tax conscious in things like an investment or a brokerage account. And that's where you would want to put something like ETFs or individual stocks. Now bonds, you have to be very careful about because you'd want those bonds to not be taxable at the federal level because every year they're just going to be a drag on the return you get in that portfolio. So that's a little bit about growth. And now there's another nuance here about growth, which is if you have assets that you know are rapidly appreciating and growing, there's an estate conversation where you want to get those out of your estate and you want to pass those down in your lifetime because you don't want that to rapidly grow and cause estate taxes. That's another transfer. That would be like growth transfer. And then finally, when it comes to growth, if you're thinking through your tax planning lifetime strategy, for example, you decide to defer in your employer plan during your lifetime in your working years, you'll realize that when you get to retirement, a lot of that money may come back to you and you may be paying a lot of taxes. So you may want to think about that and say, when might I want to convert some of this money from tax deferred into tax free? And that's another conversation that can happen. That could be low income years, that could be early in retirement, but you're factoring in growth from the beginning. So growth is actually a really important and nuanced part of tax planning that you want to think about from the beginning. Hope it's helpful. I'll see you next time.